So, in part one, we showed opportunity cost, this massive invisible cost that we all have. And now we're going to show how we can utilize the infinite banking concept to recover opportunity costs. And remember, we're not changing anything we're doing. We're just going to use a more efficient cash flow management tool such that we recover opportunity costs. But we don't change our spending or investing or saving habits. We just use a more efficient cash flow management tool. So, what if we could recover opportunity costs? We'll spend and invest our money like we normally would, except now we're going to recover opportunity cost. So, we still have the cash cost of everything that we're going to do, whether we're spending or investing our money, we still have that cash cost. We cannot print money out of thin air like the Federal Reserve. So, we still spend the money, so we still give up the money, but what we don't give up is the earnings on that money. So we still have the cash cost today of $10,000, but we recover the opportunity cost, what our money could have earned. And here we're assuming that same 4% discount rate. So a $32,000 opportunity cost minus the $10,000 cash cost, which we still have. So in this example, over 30 years, we would recover $22,000. So we still spent the $10,000. We can't avoid that, but we recovered what we could have earned on it. It's kind of like using a rewards earning credit card, right? If you take $10,000 you're going to spend anyway, and you put it on a rewards earning credit card that gives you 2% back. Now you still spend the $10,000, you're not changing anything you're doing, but you get 2% back just by using a more efficient financing mechanism. We're doing the same thing here, except instead of a one time rebate, we're getting a compound return, which continues from now until the day we die. So in this example, we're getting a 4% compound return on that $10,000. So we still spent the 10,000, but we recovered what we could have earned on the 10,000 safely. So how do we do this? By utilizing the infinite banking concept. How does that work? Well, let's take a look. So how are we going to recover opportunity cost? So we're going to utilize specially designed whole life insurance policies as our primary cash flow management tool. How does it work? So we're going to manage our cash flow like normal, except we're going to run it through a different vehicle. So in this example, we're not going to spend $10,000. What we're going to do is we're going to take out a $10,000 policy loan against one of our policies. And this is assuming we've already built the capital in that policy. Again, we cannot print the money out of thin air, but instead of putting our money into a bank account and then simply withdrawing it and spending the money where now that money is gone, we instead pay that money as premiums into our whole life insurance policy until we built up enough capital that we start using it. So because we borrowed against the policy and didn't withdraw anything, that means the full principal balance still keeps earning for us. So we take out a $10,000 policy loan. So our net cash value in our whole life insurance policy is reduced by $10,000, but the entire principal balance in our whole life policy keeps earning even while we're using the cash via a policy loan. Okay. And here I've taken away the numbers because what you earn in your whole life policy depends on multiple factors, depends on how we design it, et cetera, et cetera. That's where I come in. We'll design it, obviously, to perform optimally. But the point is, you will keep earning a safe compound interest return inside your whole life policy, even while you're using the money. And the earnings typically would be competitive with a savings account. We're not talking about dramatic earnings here. We're talking about a safe rate. But the difference is you're not locking any money up in jail. You're not parking your money in a vehicle and hoping for a return. You're taking your cash flow and you're running it through a more efficient vehicle and now opening up a new profit center in your personal economy that you didn't have there before. Now let's talk about a policy loan. Some people get scared when they hear the word loan. Well, a policy loan is not a debt. On that $10,000 policy loan, there are no repayment terms whatsoever. You pay it back if, when, and how you please, or never. It's totally up to you. The reason why a policy loan has no repayment terms is because remember, this is a whole life insurance policy. There is a death benefit on that policy. So if you take out a policy loan from the insurance company and you never pay it back, all that happens is the death benefit will pay off the loan. However, We want to do what Nash recommends, who's the creator of the infinite banking concept, and that is to play honest banker with yourself. You set up your own private bank and you want your bank to be profitable. Okay. So it's generally better, while not required, it's generally better to play honest banker with yourself and pay yourself back according to the schedule that is more optimal for you, right? So you decide what makes the most sense in terms of paying yourself back. And when you pay yourself back, you're just recapitalizing your own bank and you have total freedom. If you need to pause payments, no big deal, right? The schedule is totally up to you. No one's going to come and repossess your house. There's no credit check or anything like that to take out a policy loan. It's a contractually guaranteed right that you have. So at some point, you will pay yourself back $10,000 plus interest, and now you have the full principal balance available to you again. So with infinite banking, we are going to be recycling our money through this constant process of paying premiums into our whole life policies, borrowing against them using a policy loan to finance whatever we were going to do anyway, and then paying them back. So with infinite banking, you allow all of your capital to keep earning for you even while you're using it.